Hey guys, today we're going to talk about top 5 ETFs you can use to build a passive income. These ETFs are designed to give you a high amount of dividends while also being diversified to reduce your investment risk. Obviously, none of what I'm about to say should be taken as financial advice, but I'll be talking about the costs, the cons, the pros, and all the rest of it in between. And I'll also be telling you where to exactly buy these funds so you don't have to spend time Google searching. So first we have the Invesco S&P 500 high dividend and low volatility ETF. Their annual dividend yield is around 3.5% and their management fee is 0.3%. If you don't know, Invesco is a large investment management company in America and they have a lot of ETFs on the market, sort of like iShares does. This particular ETF focuses on stocks that are in the S&P 500 but also meet the condition of having low volatility. The point of having low volatility is to reduce the amount of times you see ups and downs in your portfolio, sort of like you would have if you invested in Dogecoin. Now, if you invested in this ETF, it currently splits your investment into 50 different companies. And I gotta say, these aren't the high-flying companies you normally see, but these companies do aim to give you a high amount of dividends on a continuous basis. Now, you can find out more about this fund in the link in the description below. But if you look at the top 10 holdings, you're gonna see the likes of Philip Morris, AT&T, CenturyLink, and many others. The top 10 holdings of this fund make up 30% of the entire investment. This just simply means that every pound you put in is going to go to the top 10 holdings of the company. And if we dive into the sector allocations, you're going to see that most of your dividends, or precisely 58%, is coming from 4 different sectors, which includes utilities, information technology, consumer staples, and communication services. And if we take a look at the stock chart, we can see that since 2015, it's been relatively stable. And to be honest, since the drop in March 2020, it's not reached the all-time highs just yet. It's seen quite a slow and steady recovery. It's certainly not the #1 fund if you think about the longevity of the companies it holds. Like Philip Morris, I don't personally buy into this whole theory that tobacco companies are here to stay for a very long time. Now, you've probably heard this a million times, but I feel like the industry itself is going to decline as more and more people are smoking less. It even says on their website, if you go to philipmorris.com or whatever, it actually says that they're trying to transform the company into a smoke-free future. And it's not just Philip Morris you're going to see doing this. There's a lot of tobacco companies, they're all following the same trend. They're trying to build their brand portfolio outside of tobacco, outside of cigarettes. And I don't personally buy into this. I don't see them doing this well, especially now that their payout ratio is around 86%. That means they're giving out 86% of their retained profits to shareholders, leaving them less money for innovation and product development. Now, that's just one example of a company the ETF holds, which means it could mean it's more risky and less sustainable in terms of the dividend payments dropping. But there are some good stocks in the fund. Obviously, the rules of the fund are actually set to kick companies out if the volatility becomes more than their comfortable amount. So with the ticker symbol HDLG, you can find this fund on Trading 212 and on Free Trade. Now, next we have the SPDR Emerging Markets ETF. Now, this ETF may seem like a good option for those who want to tip their toes in emerging markets, but don't actually have the time to research consumer behaviors and learn about individual stocks in those countries. By giving yourself at least some exposure in emerging markets ETF, you're essentially betting that countries like China, South Korea, and Taiwan are set to grow after a period of time. Now, this isn't just a standard emerging markets ETF. It follows a set of rules. It has some standards, guys. The standards are that the companies in the fund must have increased or maintained the dividends for at least 5 years. Now, that's 5 years in a row. Now, it currently gives a dividend of 2.55% with a management cost of 0.55%. Now, there's certainly a couple downsides to the fund, which mean that it doesn't make it the #1 fund for me, and certainly doesn't mean that I'm going to put a high amount of money in the fund. The #1 thing is that a lot of companies in emerging markets are in the growth stage. The countries are growing, the economies are growing, so they're growing as well. That doesn't necessarily mean they're giving out a dividend. It means you're left with a lot of companies here with low growth potential compared to their non-dividend counterparts in those countries, and not all of the stocks here have a good outlook in terms of their future. Also, although it gives you some exposure into emerging markets, it misses out some massive countries like India, for example. But like with all things investing, you need to really realize your end goal. If your goal is to get growth from emerging markets, then you're probably better off investing in a standard emerging markets ETF and not a dividend specific ETF, because then you can get access to a wider range of stocks from those emerging markets. Also, some foreign markets are not actually that transparent when it comes to the accounting practices, so you might not be able to really see the whole picture with a certain stock. So there's definitely a risk there if things go bad in the sort of accounting department and the stock price may drop. Of course, you've seen this with American companies as well, like Enron, but I do think like emerging markets have a little more risk when it comes to this. This ETF is available on Trading 212. Next, we have one of the best ETFs on the market for diversification. But before we get into it, please do drop me a like, guys. It really does help out the channel, and subscribe if you want to see more videos like this. But anyway, let's get back into it. So the ETF we're talking about here is the SPDR Global Aristocrat ETF. It follows a rule where each of the companies in the ETF must have increased or maintained its dividend amount for at least 10 years. Now that's quite a big factor. If you invest in a company for dividends, you want to park your money where it's not going to just stop its dividend tomorrow. And each year a company maintains or grows its dividend, it builds trust among shareholders, especially dividend investors. So with this in mind, a lot of people that end up investing in a company are dividend investors, those who primarily focus on dividend paying companies. Therefore, if you think in terms of a mind of a company, if you have a high pool of dividend shareholders, you're going to be less likely to cut your dividends next year or whatever, because you don't want to upset those shareholders, unless obviously you have to because you don't have enough money. So therefore, the dividend you're going to be receiving is from companies who are consistent in giving out the dividends and are probably intending to do this for a long time at least. Surprisingly, if you look at the back-end sectors of the fund, 25% is in financial services. It currently gives a dividend yield of 3.4% with a management cost of 0.45%. The fund is available on Trading 212 and Free Trade Plus. Now we looked at emerging markets, global funds, but now we're going to head back to the UK for the next one. This is of course the SPDR UK Dividend Aristocrat ETF. It currently gives a dividend of 2.90% on an expense fee of 0.3%. It currently features 35 companies and has a rule built in that the companies must maintain or increase their dividend for at least 7 years. I mean, it has a classic dividend plays. You're looking at the likes of GSK, Legal & General, and many others you're probably familiar with. And the majority of the fund's weighing is actually in the financial services and the consumer defensive sectors. If we look at the stock chart, we can see that the fund was mainly trading sideways since the fund's inception. Obviously, this is until March 2020, where it saw a significant drop, which it hasn't fully recovered yet. You can find this fund on Free Trade Plus and Trading 212. Next, we have possibly the most diversified dividend specialist ETFs around. It gives you an exposure of 1,579 different companies, and that is Vanguard's FTSE All-World Dividend ETF. This fund focuses on companies with high amounts of dividends from emerging and developed markets. If we look at the stock chart, it's actually trading at near enough its all-time highs, with the fund giving you a dividend of 2.65%. You can find this fund on Free Trade, Vanguard, and on Trading 212 with an expense ratio of 0.29%. Now guys, if you're investing for dividends, then you might want to check out my video on the top 4 UK REITs. But anyway, thank you so much for watching. Drop me a like if you find this video useful, and I'll see you in the next video.